Assalamualaikum. Today we want to present about the financial statement analysis we do for TMB company. Financial statement analysis examine financial data on financial statement in order to make well-informed company decision. The data gleaned from this study can help internal and external stakeholders make better decision. It is necessary for a business to know that the data is generated must be compared to similar data from other businesses in the industry and well as near competitors.
Hi everyone, today I'll be explaining working capital, its meaning and why it is important for a business. Working capital refers to day-to-day financial resources a business uses to run its operation. It involves managing current assets like cash, inventories, marketable securities, and account receivable as well as current liabilities. The formula is simple, which is working capital equal to current asset minus current liability. Good decisions here help reduce risk, increase return, and improve the company's market value. Why is working capital important? First, it's smooth operation. It ensures the business can pay workers, suppliers, and other expenses on time. For example, TNB needs a strong working capital to keep power plant running and pay suppliers. Second is liquidity and stability. A company with enough current asset can handle short-term debts and avoid financial problems. The third one is higher profitability. Managing inventory, payables, and receivables efficiently help reduce costs and improve profits. For instance, TNB's RM 6.34 billion working capital show how strong the financial health is.
Here are the main objectives of our financial analysis. First, we aim to assess the MB's profitability, liquidity, and solvency to understand its financial condition. Next, we analyze financial data and also industry trends to support better investment and strategic decision. We also identify potential risks and find ways to manage them effectively. Lastly, we aim to optimize resources, improve cost management, and also enhance overall profitability.
Now, I will explain the categorization of assets and liabilities for Tenaga Nasional Berhad. For the assets, TNB holds a wide range of resources that supports its operation. These include long-term assets such as property, plant and equipment, right-of-use assets, subsidiaries, joint ventures, intangible assets, long-term receivable, and many more. TNB also has financial instruments like investment at fair value, derivative assets, and contract cost assets. For current asset, the company records inventories, receivables, deposits, prepayments, contract assets, short-term financial instrument, and cash balance. These are the assets expected to be converted into cash within a year. On the liability side, TNB's obligations include payables, contract liabilities, employee benefits, lease liabilities, consumer deposits, and both short-term, long-term borrowings, and more. The company also records deferred tax liabilities and government development grant as part of its loan responsibilities. Overall, this categorization shows how TNB organizes what it owns and what it owes to support a very large-scale and capital-intensive business. Next, let's highlight the difference between temporary and permanent current assets. Permanent current assets are the minimum level of current assets that TNB must always maintain to run daily operations. These include minimum cash balance, contract assets needed to support continuous projects, and the baseline receivables that come from regular monthly billing. On the other hand, temporary current assets fluctuate depending on seasons or operational needs. For TNB, this may include higher inventory levels during certain periods, short-term receivable from peak billing months, and short-term financial investment used during periods of excess liquidity. Understanding this difference helps the company decide the most suitable financing approach for each type of assets.
So now we want to calculate net working capital of TNB. The formula to find net working capital is current asset minus by current liabilities. For this company, the current asset is 40,308.2 million ringgit Malaysia. For the current liabilities is 33,968.1 million ringgit. And we minus them, we get 6,340.1 million. It shows that net working capital for TMB is positive and represent good quality position. Next, we calculate current ratio. The formula to find current ratio is current asset divided by current liabilities. Therefore, we get the current ratio equals to 1.17.
I will explain the financing sources used for current and fixed assets. For fixed assets, TNB relies heavily on long-term financing. This includes issuing SACEC, term loans, and receiving development grants for large infrastructure and national utility projects. The company also uses retained earnings to fund asset renewal and system upgrades. For current assets, TNB uses a mix of short-term financing tools such as revolving credit and short-term SACEC to cover operating costs, especially fuel purchases. Daily operations are additionally supported by customer deposits, trade payables, and strong cash flow generated from electricity sales. This combination helps TNB maintain smooth operations while balancing long-term investment needs with short-term liquidity.
Okay, next I will explain working capital policy, which refer to how a company manages its current asset and current liabilities to ensure smooth daily operation. There are three main types of working capital policy. First, relaxed policy. Second is restrict policy, and last is moderate policy. Okay, the first is relaxed policy. This policy uses a low-risk approach. The company maintains a large amount of current assets such as higher inventory levels and more cash. The result is high liquidity, making the company safer in the short term. However, the returns are usually lower because too many resources are tied up in non-productive assets. Okay, next we move to restricted policy. Okay, this policy is a high risk, high return approach. The company keep minimal current assets so we can reduce in holding costs. Because if fewer resources are tied up, the company can achieve higher returns. However, liquidity is low, which increase the risk of cash shortage. Okay, last but not least, we have moderate policy. This policy takes a balanced approach between risk and return. The company maintains adequate level of current asset, which is not too high and also not too low. It aims to balance liquidity with profitability, ensuring smooth operation while still earning reasonable return.
In this slide, we can see three different working capital policies: relaxed, moderate, and restricted. The vertical axis represents current asset, while the horizontal axis shows sales. A relaxed policy keeps high level of current asset, meaning the company prefer more liquidity and lower risk. A restricted policy, shown by the lowest line, keep very low level of current asset, meaning higher risk but lower cost. The moderate policy, which is in between, balance liquidity and efficiency. This graph helps us understand where a company's working capital approach might fall based on how they manage their current asset relative to sales. Working capital policy identification. Based on the company financial numbers, the current ratio is 1.19, which falls in the lower liquidity range. This suggests that the company leans toward restricted working capital policy because it maintains only slightly more current asset than current liabilities. However, even though the ratio is on the low side, the company still has positive liquidity, meaning it can still meet a short-term obligation. This tells us the company is not aggressively minimizing liquidity. Instead, it maintains just enough current asset to operate smoothly. Therefore, although the ratio is closer to restricted, when we look at the overall structure, the company is actually moving within a balanced or moderate working capital policy. This final graph highlights the moderate working capital policy. A moderate policy keeps current asset at a balanced level, neither too high nor too low. It shows that the company maintains enough liquidity for daily operations while still controlling costs. This aligns well with our earlier conclusion that the company overall approach fit within a moderate working capital policy.
Now, let's move on to the working capital approach. This approach explains how a company finances its current asset, whether using long-term funds, short-term funds, or mix of both. There are three main approaches, which is conservative approach, aggressive approach, and also hedging approach.
Now let's discuss about type of working capital approach. As we learn that we have three different types, that is conservative approach, aggressive approach, and hedging approach. So for the first one, conservative approach, it prioritizes safety and stability. So that's why conservative approach has the lowest risk. Under this method, we use long-term financing for the majority of assets and resorting to the use of short-term financing only for the very peak requirements. It is best suited for firms that operate in uncertain markets or want to avoid liquidity problems. So the second one is aggressive approach. Aggressive approach focus on maximizing profitability, even if it means taking higher risk. So that's why aggressive approach involve more risk. It uses short-term or temporary financing to support a relatively large portion of current assets, and it finances all fixed assets with long-term financing, but only a portion of the permanent current assets. Companies with strong cash flows or those operating in stable industries may use this strategy to boost returns. And the last one is hedging approach. Hedging approach, also known as the matching or hedging approach, strikes a balance between risk and return. In this approach, we use temporary financing to finance temporary current assets and use permanent financing to finance permanent assets. It finances fixed and permanent current assets with long-term debt, and the fluctuating current assets will be financed with short debt. It minimizes risk without sacrificing too much profitability and is considered the most balanced and practical approach for many businesses. In this section, we learned that choosing the right working capital approach depends on company's financial strategy, risk appetite, and business environment. The conservative approach offers safety, the aggressive approach aims for higher profits, and the moderate approach or hedging approach provides a balanced middle ground. So for the next part is we will discuss about working capital approach identification for the company that we already do some research. So we will prove that Tenaga Nasional Berhad (TNB) appears to adopt a conservative approach. We have three reasons to prove that TNB used the conservative approach. The first one is strong long-term financing matched with long-term assets. It is because we can see that the non-current assets of TNB like property, plant, equipment and other similar kinds are very large. The second one, we have maintaining adequate liquidity and manageable leverage. We already see and know that TNB have the 5-year group financial summary that shows gearing 47.8% in 2024. Credit rating agencies also give TNB top ratings that is reflecting the confidence in its financial resilience and its status as a national utility. Other than that, the stability of earning also supports a conservative approach. And the last one, the third one, for the proof that TNB appears to adopt conservative approach is risk management and regulation environment. The reason is TNB is a regulated utility and benefits from government support. its business, risk is lower by implying less incentive to take aggressive financial risk. Then the company use derivative and other instruments for hedging, aligning with risk averse. So here is the paragraph that have graph which is shows the conservative approach.
Here come to the conclusion. In conclusion, Tenaga Nasional Berhad, which is TNB, has a strong and stable financial position. Its steady growth show that the company manage its finance well and can cover its short-term obligation without issues. The working capital analysis confirm that TNB maintains a good balance between its asset and liabilities, allowing smooth daily operation and avoiding liquidity problems. Overall, TNB shows good financial performance, effective resource management, and a commitment to long-term sustainability. Without continued improvement, TNB is set to remain a leading energy company in Malaysia.